The topic of this essay is raising capital. That makes it a Part 2, Section B question, and our company is Apex Corp. And when we say that this is an essay, this one really is an essay because this is an entirely written question in terms of sentences and small paragraphs. We don't have any calculations, we don't have any numbers included in this, but that's fine. We're prepared for it, and it's absolutely something that we're ready to get 100% of the points for. So let's go ahead and start by reading the situation and then looking at the requirements. Apex Corp is a mid-sized retail company selling home appliances. Apex faces competition from large national chains as well as local retailers and needs to raise money to finance its expansion into new markets. The company is currently operating at break-even, but believes that the expansion will help it become more profitable. Based on the company's analysis, it plans to open up to 10 new retail locations without adding costs to its human resources, accounting, information technology, and legal departments. Since the company cannot fund the expansion through operations, it is considering financing options such as issuing more common stock, creating a class of preferred stock, or issuing bonds, convertible securities, or warrants. So that's all of our information. A couple of things here just to kind of keep in mind at the beginning. They are currently break even, but they believe that the expansion will help it become profitable. They're planning to open up to 10 new retail locations without adding cost to HR, accounting, IT, and the legal departments, but they do need to raise money somehow, and so they are considering a number of different financing options: common stock, preferred stock, issuing bonds, some sort of convertible security, or a warrant. And so that's the information that we're given. There are actually 5 requirements that we're going to have to go through in this. The first, define operating leverage and describe how the operating leverage created by the expansion will affect the company's return and business risk. Second, define financial leverage. Third, define and identify 2 characteristics of common stock and preferred stock. Fourth requirement, describe the maturity, par value, and coupon rate for a bond. And 5, identify and explain 1 advantage and 1 disadvantage. Okay, so we need to have 1 advantage and 1 disadvantage of raising capital through common stock, preferred stock, and bonds. And so we have 3 things there that we have to answer, give 1 advantage and 1 disadvantage for. But that is our last requirement. We'll get to that in a little bit. We'll go ahead and we'll start with requirement number 1. Define operating leverage and describe how the operating leverage created by the expansion will affect the company's return and business risk. Now, the answer that we have here is what was provided as the suggested answer. It's not the only answer that's available. It's not the only way that it can be written. But you want to make certain that what you write has these same kind of fundamental basic elements to it. So this is the answer. Operating leverage is the use of fixed operating costs by the firm to increase profitability. So right there, that first sentence is to define. Okay, we defined what it is, the use of fixed operating costs by the firm to increase profitability. Operating leverage affects the level and variability of the firm's after-tax earnings and hence the overall risk and return of the firm. Operating leverage is present anytime a firm has fixed operating costs that don't change as volume changes. A change in the volume of sales results in a more than proportional change in operating profit. Now, we're not done yet, but right here we have this fixed operating costs that don't change as volume changes. Well, remember they said that the accounting, the IT, the HR departments aren't going to have to increase. And so there's this cost that's not going to increase as they expand. So continuing, in this scenario, if the company opens up more locations, they will have an increase in sales without an increase in the fixed costs of the HR, IT, accounting, and legal department. So these fixed costs are leveraged across more locations and should create a higher return, which lowers the firm's risk. So we had the definition there. We described how the fact that they were going to increase their operations without increasing those fixed costs of the HR, accounting, and IT departments, and that's going to create a higher return and lower their risk. And so this answer went right through what it is they asked for in that requirement. So the second requirement is define financial leverage. Okay, that's all it is define. And so the answer here is a little bit longer than that, but that's okay. Financial leverage is similar to operating leverage in that it uses fixed costs to increase profitability. By borrowing or undertaking long-term leases, the company is committed to paying these fixed financing costs. But if operating profits are high enough to permit debt service or lease payments, remaining operating profits flow to shareholders. The shareholders have less of their money at stake as some of the investment is paid for with borrowed money or leased. Thus, the RO return on equity is high, but if operating income is not enough to cover debt service or lease payments, the lenders can take control, wiping out the shareholders. Now, this answer really goes beyond what it is that was asked in the question. The question simply asked, define financial leverage. And they did that, and they went a little further than that. But I guess in this case, better to have too much than too little, but I think some of what they have here in this answer really isn't necessary in order to answer what it is that they asked. The third requirement, define and identify two characteristics of common stock and preferred stock. Okay, so we need two characteristics of common stock and two characteristics of preferred stock. We want to make certain that we get both of these. Here's the answer. Common stocks are securities that represent the ultimate ownership and risk position in a corporation. Their liability is restricted to the amount of their investment. I like that as going in there. That's an important characteristic of common stock. In the event of liquidation, these stockholders have a residual claim on the assets of the company after the claims of all creditors and preferred stockholders are settled in full. It has no maturity date, and shareholders can liquidate their investments by selling their stocks in the secondary market. Common stock dividend is not fixed or guaranteed. It is discretionary of the company. It is discretionary of the company and depends on various factors such as profitability, cash sufficiency, and future operating strategy. Common stock dividend is not tax deductible as interest or lease payments from the standpoint of the company. Again, they could have presented this answer a little more numerically in terms of 1, 2, but I think the characteristics is we have limited liability of the shareholder, and you could say there's no maturity date would be one. The dividend is not fixed or guaranteed would be another one. And the dividend is not tax deductible as interest or lease payment. So a number of different characteristics that we can choose from to get the two that the question is actually asking us for. Now, that's the common stock. We also have preferred stock. Preferred stock is a hybrid form of financing combining features of debt and common stock. In the event of liquidation, preferred stockholders' claim on assets comes after that of creditors, but before that of common stockholders. Preferred stock carries a stipulated dividend. The actual payment of a dividend is a discretionary rather than a fixed obligation of the company. The maximum return to preferred shareholders is usually limited to the specified dividend, and these stockholders do not share in the residual earnings of the company. Most preferred stock is held by corporate investors. Well, again, it asked for two, and so I think we have here this in the event of liquidation where it is that preferred stockholders are going to come in that list of who gets money. And again, the fact that the dividend is a discretionary decision. It's not something that is required to be paid every year, but the company is going to make that decision as to whether or not the payment of dividends is going to take place. So that was the third requirement, the characteristics of common stock and preferred stock. The fourth requirement is describe the maturity, par value, and coupon rate for a bond. Okay, we can set this up. If you want to make this a bullet list, that would be fine because we have to describe these three things. So we start. Definition of a bond. A bond is a long-term debt investment with a final maturity generally being 10 years or more. The maturity is the time when the company is obligated to pay the bond holder the par value of the bond. Okay, so there's maturity, obligated to pay the par value of the bond. The next one is the par value is the amount to be paid to the lender at the bond's maturity. Par value is also called face value or principal, and most bonds pay interest that is calculated based on the bond's par value. This is a very nice answer about par value, what it is, what it's called, and how it is that it's used. Very good answer for that. And the coupon rate is the stated rate of interest on a bond. The indenture is the legal agreement, also called the deed of trust between the corporation issuing bonds and the bondholders, establishing the terms of the bond issue and naming of the trustee. Again, the indenture, this whole part here, is probably a little bit excessive. It's not really the coupon rate for the bond, but that's where we get that information, kind of that bond agreement as a whole that has all of this information in it. So this then takes us to the fifth requirement: identify and explain one advantage and one disadvantage of raising capital through common stock, preferred stock, and a bond. And so we again need to just have three kind of sections here as to how this is going to be. Something about common stock, something about preferred stock, and then something about bonds. And again, we want to have one advantage and one disadvantage of each of these. So common stock does not have a maturity date or require a regular interest payment. However, the cost of capital of common stock is generally higher than that of a bond, and the current stockholders' voting power will be diluted. If the company is not publicly traded, an initial public offering is expensive, complex, and time-consuming, and it will be subject to more regulations. Okay, this is all good. We've got a couple of advantages, a couple of disadvantages. The thing you could do here is specify what's the advantage and what's the disadvantage. An advantage of common stock is that it does not have a maturity date or require a regular interest payment. However, a disadvantage is that the cost of capital of common stock. So we can just kind of add that in to clarify a little bit. So that's common stock. Preferred stock does not have a maturity date and will not dilute the current shareholders' voting power. However, the cost of capital of preferred stock is generally higher than that of a bond and is not as attractive to investors. Okay, so right there, could have just added advantage and disadvantage, but very clear as to what it is that we're talking about. And finally, about bonds. Bonds generally have a lower cost of capital and have tax benefits on interest payments. However, making regular interest payments can be a burden to the company, and there might be a bond covenant which prohibits the issuer from undertaking certain activities or requires the issuer to meet specified requirements. So, lower cost of capital, and there are tax benefits of the interest payments, but can be a burden to the company, and there might be a bond covenant which prohibits. And so, again, we didn't use the specific terms advantages and disadvantages, but I think it's fairly clear what it is that we're talking about here. So this was an essay. There were no numbers here, there were no calculations here, but if we just go step by step through, look at what it is that is being asked from us, make certain that we answer that question, help out by putting numbers 1, 2, 3 where it's appropriate, making it easy for the person who's grading our essay to see that we know what it is that we're talking about, and we have answered all of their elements, all of the things they've asked about, which means we're in a position to get 100% of the points from this question.